All right, so let's focus on one of those segments. Stock market investors lost around 4 lakh crore rupees today, but the Nifty Realty has been among the worst performing sectors lately. The reasons for that seem quite obvious. No other sector is probably as sensitive to rate hikes as the realty sector. And, the graph on your screen sort of says it all. A 50 lakh loan on a house costs around 20% more for borrowers every month. While you would imagine rising rentals would make owning a house more valuable, markets just don't seem to buy into that narrative. Today on the show, we discuss the health of India's realty sector and find out if realty has now lost the plot. But before that, let me go across to my colleague Sharad, who's giving us a check on how markets have punished some of the major listed players and what the reasons for that is.
Well, yes, the real estate segment is in focus today. The Nifty Realty Index is at its 7-month lows and it's already down 10% this year. But what are the main reasons why the real estate is under pressure? The first reason being the interest rates, and that they are at the higher levels, and because of that the home loan rates are also expected to be north of 9% to 10% mark. Apart from this, of course, the global slowdown has also impacted the commercial real estate deals, and the most vulnerable part, that is the affordable housing segment, and analysts expect that to be hurt a lot. Apart from this, the rising input cost for developers is also a main problem. Because of that, the price hikes also will be taken in a calibrated manner. Now, these are the main reasons why the real estate is under pressure. But now let's look at how the pricing has changed, at least in the year end of 2022. And taking the survey from Anarock, the average home prices that has increased to almost 6% on a year-on-year basis, and looking at a 1 BHK prices on the rental basis, that is also up by 23% as we compare it to the 2019 levels. Now, looking at the fall of real estate stocks, they have also fallen between 20 to 55% from the 2022 highs as well. But what are the important triggers going ahead for the real estate space? And of course, the most important is that the luxury and the big ticket sizes have actually performed really better in these situations. Apart from this, even the commentary is coming in that there might be a slowdown in the launches going ahead, and lastly there might be escalations, however, in the lease rental agreements, so the yields might improve in the commercial aspect.
All right, so what is the direction that the real estate sector is taking? Ankita Sood, Head of Research at Housing.com, with me on the show. I'm speaking with Ghulam Zial, Senior Executive Director at Knight Frank India, and Shoaib Ahmed, Head Sales and Marketing at Dark Limited. Welcome to all of you, and thank you so much for speaking with us today. Ghulam Zial, let me begin with you. Now, the real estate stocks and their performance is not necessarily telling us the entire story about the sector. Very often those two are divergent, but there is a trend that we're seeing, and we're talking about how these stocks have performed over the last several months, what is being read into the financial results of some of these listed companies, and the picture that is emerging is that the consistent interest rate hikes are now beginning to hit home. Is that something you're seeing as well?
Well, I would say it's a bit too early to jump to that conclusion because the impact of rate hikes, at least as far as I'm watching, isn't so very evident on the ground yet. For every of such, reports that we're talking about, we have to also look at a lot of other such inputs coming in. Like I was reading something, DLF sold huge, a complete project in a flat 3 days, some 1,200 apartments sold. So these are things which are, very difficult to immediately decipher and reach a certain conclusion. I would say it will definitely impact the rising home loan rates, which has happened last 6 or 7 consecutive rate hikes, will definitely have an impact. But so soon, barely a fortnight, I don't agree. We need to wait and watch because we still see a lot of traction happening. And I have been watching the data. The closure of January was much better a January over last 7, 8 years. So the point still remains that after so many of home loan interest hikes, if the consumption of apartment is not yet slowing down, then are we reading a lot in these data points that you're just about referring to?
Look, let's look at the data that you're talking about. You're saying too early to say this in a fortnight. Why are you referring to a time frame of a fortnight?
Because I was talking about January data. The end of January, it was actually one of the best Januaries, at least when I'm looking at the Mumbai data. I was very closely watching Mumbai data. It was one of the best Januaries in last 6 years.
But that's
So
Mumbai.
I would still
But
not
that's
jump
just
to that
Mumbai.
conclusion.
But that's just Mumbai, Mr.
The
Zia.
other, I agree. The other traction, I would say there are a lot of these smaller points that I spoke about, some traction numbers coming from a few developers when they're launching new projects is defying all this. So we need to really wait till all these data points start, looking similar.
Okay, so the thing about the way stock markets respond to sectors, it's very dispassionate, right? They're looking at it from the point of data. Their investors are in it because they want to know how that sector is performing and whether they will see long-term growth or not, which is why there's something to be said for the kind of response we're seeing. Ankita Sood, I want to get your take on this because for a long time and for the last few years, the affordable housing story was looking very exciting for the sector. Has that cooled off? Because even if you would say that, oh, a set of apartments for 100 crores plus has been sold in South Bombay, that makes for an excellent headline. It's not telling us about the bulk of sales out there, which was supposed to come from the affordable housing segment. Is that showing signs of cooling off?
Yes, definitely, Tamanna. If we look at the data, the affordable segment has cooled off. Definitely, they are the price sensitive category. And looking at the data, luxury segment and the mid to luxury segment have actually grown at the fastest pace, especially post the pandemic. So definitely the affordable housing has shown signs of cooling off, definitely, because they are a price sensitive segment.
Affordable housing is cooling off, but luxury is growing at a fast rate. That's interesting because you see a similar pattern. It's a bit of apples and oranges, but just to look at consumer trends, a similar pattern, say, in the automobile sector, where two-wheeler growth is not as high as your luxury cars, but it's the volumes at the end of the day that you need to look at. Shoaib Ahmed, how do you see this situation and the kind of hammering that real estate stocks are getting? I know you might not want to comment on individual stocks, and I'm not asking you to over here, but what is the direction that we're seeing for the sector?
As Ankita just said, so for luxury, the last few months, and especially the time post the pandemic, it has been one of the best times for luxury and mid to high income segment. The kind of demand and the robust sales that all developers have posted is a testimonial to that. As Mr. Zia just mentioned, there was a project, DLF recently launched in Gurgaon where apartments were 8 crore upwards, and they were able to sell that off in less than 3 days. So that's the kind of demand which is there for luxury, and that's the kind of absorption we are seeing. So it's too early to comment, how these interest rates are going to affect this demand and the high sales volume that the developers are getting. And what we have seen is that the rate hikes which have happened in the recent past, they have not dented the demand and the sales volume. And we personally feel from the data which is coming that this might be, towards the end of the rate hike cycle of RBI. So if it has not impacted to that extent till now, I foresee that the demand will continue to
Which
grow,
data
especially
are
for
you
the
referring to?
high income.
Sir, which data are you referring to when you're saying that you're not seeing any dampening down in demand?
No.
Because
I'm just talking about the rates. The rates have been hiked by RBI, but
correct.
the sales volume, like I mentioned about DLF, Godrej launched a project which is a tier two city, which is like 100 kilometers from Delhi. There, the entire project, people were standing in queues, and it was sold out in a matter of 3 days. So the kind of sales that are being reported by all the the category A developers across, especially in North India. So it is growing year on year. It is
No,
growing
but then
quarter on
see,
quarter
that's
as
again,
well.
I'm also showing you data, right? I'm showing you how real estate stocks have come off their 2022 highs. DLF is down 16%, Godrej is down 34%. And okay, you say those are stock market prices, but you're talking about
Those are stock
specific
market prices,
projects.
and they don't. They the impact is not directly proportional to. You are saying that the stock market price got a dent because the rates were hiked, but the actual ground reality of the sales volume reported by these very developers like a Godrej
But
or a
those are
Brigade or a
specific
Prestige.
projects. My only point is those are specific projects. Like I cannot extrapolate today the hit on the stock prices to the health of the sector, can you extrapolate interest in specific projects to the robustness of the
I
sector?
feel it's time to wait and watch. It will take
Okay.
some time. It will take some time to have to gauge the actual effect of the rate hike on the stock prices also, and the situation on ground as well. It's too early to comment on that.
Too early to comment is the view coming in from Shoaib Ahmed. Now let's look at what input costs are doing for developers as well. Ankita, you're smiling over there. You're saying that she's fighting a losing battle, but remember, there is skin in the game for everyone on this panel.
I actually would concur with what Shoaib has said. Demand, it's too early to read into the rate hikes. The
Right.
demand is at a high. We track a realty index, which tracks the potential home buyer activity across our platforms. And Tamanna, that is above the 100 mark. So people are looking out. There
But
is
the
demand.
moment you say potential home buyers, they're only potential. Frankly, we have to look at the registration numbers in all the large cities to know what kind of a jump there has actually been.
So that is what everybody is concurring to. It's too early to come on that conclusion.
Okay, let's look at the other aspect that is clear headwind for real estate developers, and that is the rising input costs, which have been increasing steadily now, I would say, for over 12 months. Some of it has been passed on, some of it hasn't. Do you think that is a continuous challenge, Ankita?
Definitely, developers had to pass on, the cost to the home buyer. Eventually, they were bearing that cost for a long time. But let's say for credible developers, that passing on has been in a staged manner, in a staggered manner. And the credible developers with good track records are still able to sell despite the hike in the prices.
Okay. So they are able to sell, demand is continuing. Is the demand, Ghulam Zia, something that you see keeping up with the continuously increasing hikes in prices? Do you think that those margins for developers will continue to be squeezed? What are you looking at as the outlook?
Well, that brings us to the debate on affordability. Last 4-5 years, due to either flat or reducing prices, the affordabilities had improved a lot. Last year was an exception where after almost about 7-8 years in most of the markets, the things turned around. But developers have realized that if they recklessly increase the prices, the same buyers who are right now waiting outside their offices would turn their back. And that is what is reflecting in the data on the price rise also. On an average, we are not looking at more than 7-8% of a price rise across the market sectors or regions, etc. And that, in my view, is not bad, because as we're talking about increase in property, in construction cost, input cost increase, etc. When you look at all that, some 5-6% of a price rise on an average all across the sector is not bad. But anytime, like if I recall the previous such era, when the developers were rising prices almost 10-20%, 10 to 15% per annum, that is where my worry still lies. As long as the developers are still maintaining their rationale as far as price rise is concerned, I don't see affordability really becoming so much a problem, because let's not forget that on one side, earlier we were discussing the rate hikes. The rate hikes have already had an impact on the affordability. So overall, as long as affordability remains within limit, I'm not unduly worried about a little price rise here and there.
What is happening in the commercial space is another big question. And Shoaib Ahmed, I don't know if you want to come in on this. So there are two factors there. Are we looking at commercial space or commercial real estate going back to pre-pandemic levels? And is there a worry that the kind of chill that the IT sector is facing right now, and that's beginning to show up in salaries and recruitments, etc., is going to have sort of a ripple effect?
It will have an effect, but we feel that it will be a temporary effect, not a long-lasting effect. People who are expanding their outlay as far as the office requirements are concerned, they might delay their decisions, But in the longer run, I think the growth will be there, and it will not be a robust growth, but a sustenance model will be there. So this effect will be temporary.
Okay. Ghulam Zia, impact of what is happening in the real estate sector and that too on the commercial space?
Well, commercial space is definitely a cause of concern. After almost about 2-3 years post the other side of pandemic, I would say, when the work from home and the stuff like that came in with a bang, people are not going back to office. But last year was really a turnaround year for commercial property as well, with almost about 50 plus million square foot of area absorbed in a year, was perhaps the best historical best, second best after the pre-pandemic year, which meant that the things were looking good. And while things were just about starting to look good for commercial sector, the last quarter of the year started showing those global pressures on job cuts, etc. In India, it started slightly later, but it has come in India as well. We've been watching job cuts right here in India as well. And pretty much every once or twice a week, you do see big brands announcing those job cuts. So that concern remains. However, that cut yet is very, very superficial and restricted to technology sector only. For India, dependence on technology sector, the ITS, had shrunk over a period of last, I would say, 15-20 years. Earlier, it used to be upwards of 70, almost about 2/3 and more of office space absorbed used to go to technology sector. Today, it has come down to barely about 35-40%, almost 1/3 or thereabouts, which means huge dependence on IT sector has changed to non-IT sectors, and that is what is little comfort. However, the concerns remain that the way things are moving globally as well as in India, that the effect of job cuts are now on ground. I would say we need to be a bit cautious. We may not see the same kind of excitement as we saw in the calendar year of 2022. The time will tell. It's only a first month and a half of the calendar year. But to start with, things are looking worrisome.
So things are looking worrisome. We'll have to wait and see what happens. And this was interesting because the MPC minutes were out today, and it showed a difference of opinion within the MPC as well on how far you can go with rate hikes where it starts impacting growth. Maybe we are at that threshold right now. Ankita, what is the kind of trends that you're seeing from the consumer's point of view? We've given a few data points where renting is now becoming more expensive. The cost of renting has grown quite high compared to even real estate prices. Ideally, that should push people, if they can afford to, towards buying a home instead of continuously renting. Why are we not seeing that transition happening?
Tamanna, that transition will take some time. Of course, the cap values have gone up, and renting, like you said, across specifically the office spaces. Now, Bangalore, our rental index has gone up. Pune, it's gone up. So despite the IT sector and, job cuts being announced, we see rentals, the index is going up. Gurgaon, the rentals have gone up. So definitely, but it's too soon to convert those rentals into actual buyers, because of course the right product is also not in the market. So when I said demand is there, demand is definitely there, but also the right product has to be there in the market. Inventories are high, but our data is also suggesting that due to the demand, even the product is not available. So all the cogs have to fit together. So it'll take some time for converting the rental person into an actual home buyer.
The state, Ghulam Zia, of the amount of inventory that developers are sitting with right now. Because a little bit after pandemic, they had gone slow on new projects, etc. So demand has started growing. Has that situation reversed?
Well, let's look at it this way. As you rightly said, the new launches had shrunk immediately after the COVID onset. Correct. However, last year, very, very interesting number that we have. We watch the velocity of sale as how many quarters required for the inventory to be absorbed. And we saw that coming down to as low as just about 2 years, which is about 8 to 9 quarters, which is great, because the inventory sale velocity that we watch is compared to construction completion time. So on one side, your average completion times are at least 2.5 to 3 years. your absorption times have, or your velocity of sale has shrunk to less than 2 years, which is great, which only means that the velocity improving will actually give you that comfort that even if the inventories are going up, the velocity has also shot up much higher. So there is nothing to worry about. What I mean is that last year, while a lot of new launches have happened, the new stocks have really shot up. But alongside the velocity of sales shooting up gives you that comfort that earlier, when it used to be 3 to 4 years of sale period required, now it has shrunk to half of that. Less than 2 years, you can absorb or sell all the wares you're creating. And that is something which also has to be seen alongside the inventory overhang. You have to also look at velocity of sale. And that is something which is giving me comfort that in spite of a huge infusion of new apartments, velocity is still on the side of developers and buyers are keenly buying yet. As I said, next couple of quarters we need to watch.
So wait and watch for the next couple of quarters. Thank you so much to all of you for joining us on the discussion this evening.